So far in the course, what we did is we start with accounting. We identify what the accounting is. So obviously, accounting is the system, the whole system of gathering the information, entering the information, analyzing the information, preparing a report, and communicating these reports with the users of the financial statements. So who are the users of the financial statements? We have two types of users mainly, which are internal users and external users. For that purpose, we're going to divide the accounting into two branches, if you want, or two different types of accounting. One will be financial accounting, which is going to deal with preparation financial reports for the creditors, investors only, and some other users, either government, either some regulators which are interested in the reports in order they to collect whatever they want to collect from the company or business. And the other type, based on the other type of the users, internal users, the other type of accounting that we're going to see is management accounting. Management accounting is focused on um, what we can do to improve the situation in the company and what else we can do to change from where we are to where we want to go. So as you can see, the objective of both accounting is different, not only based on the users, but also based on the how they prepare the information is prepared, how they presenting the information, to whom presenting information, for what purpose those users are going to use the information. Again, you understand that both type of accounting dealing with exactly the same information with exactly the same transactions. We're not going to change anything. So in order we to prepare those reports have to be have to follow some format, and it has to be prepared for somebody. Though somebody will be usually governed by the accounting with accounting designation. They should have the accounting designation. That means if you don't have accounting designation, doesn't mean you cannot do accounting. You can still do accounting. But being in part of the professional association, that gives some more confidence for the people who are using the reports, that the person who prepared the reports follow some guidance and follow some rules. So then we go to the two type of businesses or not, the form of businesses that you can create after you finish your school and decide to open your own business. So one will be the proprietorship option, the other one will be partnership, and the third one will be corporation. What's the difference? The difference is based on the ownership, based on the legal entity, and based on the liability. Now, for the legal entity, the proprietors and the partnership, the legal party is the owner or the individual, where the corporation that's separate from the owners of the business, and that brings that liability for the partnership and the proprietorship. The owner of the business or the partners of the business are responsible for company liability to their personal assets, where the corporation, there's a limited liability for the owners only to the capital they're investing. Now, how we're going to present the information, we have to follow some concepts. What will be the concepts? The concepts will be here. We have first we have to have the objective. On the very top is the objective. Who's using the information? For what purpose using the information? That's going to bring the quality of the information, and the quality when we're preparing the reports for creators and investors. The information has to be relevant, comparable, reliable, and understandable. How can we achieve that? By putting the information in the proper sections. That will be assets, liability, equity, revenue, expenses, and identifying which transactions in the company are actually related to any of those elements of the financial reports. And by preparing all those financial statements, we're going to rely on the key assumptions and principles and constraints. So once we know all this, we come up with the basic accounting equation, which is assets is always equal to liability plus equity, which means that whatever company has as an asset came from the investors or the owners of the company and from the creditors. So that means the assets that the company holds belong to either creditors, either to investors. The other way you can say it is everything that the company has, the business has, once the business pay the outstanding debts to the creditors, everything else belongs to the owner of the company, if there's anything. We come up with the idea with the assets, liability, what's assets, what's the liability, what's the equity, and equity, we saw the simple way to get the equity is from the accounting equation where assets are equal to liability plus equity. That means equity always will be assets minus liability, or that will be net of assets. Every time when somebody uses the word net, that means it's something less something else. Right? We have a gross minus something is going to give you the net amount. Now for the owner's capital, that will be one of the questions that you have to solve next time on your test, is you to calculate the owner's capital at the end of the period. Either it's going to be month, here it's going to be week, there's no week, either going to be quarter, it's going to be year, but at the end of the period, we're going to see a little bit later what kind of periods we have in accounting and what's the shortest period that we have to prepare the reports. So once we have the period, we have to calculate how much is the owner's capital at the end of the period. How we can do that? Well, we're going to start with the beginning balance of the owner's capital at the beginning of the period, plus whatever the owner invested in the company, minus whatever owner withdraw from the company, plus any income that the company generate or the business generate, if there's income, and if there's a loss, that's going to reduce the owner's capital. So technically, owner opened his business for only one purpose, to generate income. From where the income is going to come, that's a different story. The income usually comes from the revenue minus expenses. As long as revenue is more than expenses, company generate income. That means that increase owner's wealth. So the owner succeeds in his purpose to generate income or profit, as we usually say profit. So what that means is that now if you do the accounting equation, since we already know the older equity always going to be impacted by the owner's investment, money that the owners withdraw from the company, and the business activity that's generating the business from the revenue and expenses. So as long as revenue is more than expenses, that's going to affect directly the owner of the company by increasing his capital. And if the business generate loss, that means owner didn't succeed of what he want to achieve in the first place. That means it's going to reduce the owner's capital, or technically he's going to lose his money eventually if the business doesn't generate any income. That was the first chapter. That was the most important. The first chapter, and this is the case, the question that we're going to do in a few minutes, but with the knowledge that we already generate from chapter 2. So what's happening in chapter 2? To make it more organized, the whole accounting, to make it organized, to make more sense, what we did is we put it in some kind of order. So in the very beginning, we said that first we have to identify, is there transaction, if there's a transaction, if there's event that happened, is that event or transactions is related to the business? If the answer is yes, then we have to record that transaction into the journal. Journal, imagine you have a notebook. In every page, you're recording different type of assets or different type of liability. So on first page, you're going to label it cash. So everything that's related to the cash, you're going to put it on that page. Cash coming in or cash going out. So once we put on every single page different accounts, then whatever is below, that will be our journal entry. So that's how we're going to keep track of what happened in that particular account. So once we combine all the accounts, all the sheets in the same notebook, that will be our ledger. And at the front of the ledger, we're going to have list of all the accounts plus the ending balance at the moment that we're looking at the page. So that will be our trial balance. So how are we going to organize this? Very simple. Again, we need the accounts. Every single, whatever activity we have or whatever assets we have, whatever liability we have in the company, owners capital we have, revenue, expenses, we're going to put it in the separate account because we want to keep track of those things. So the question will be, do you want to know how much money you have in your bank account? Obviously, yes. So for that reason, we're going to open account. Do I want to know if I have computer in my business or not? Yes, I want to know. So I'm going to open a new account for the computer. In that account for computer, do I want to know exactly what kind of computers I have, how many computers I have, and what's the purchase price of every single computer? Answer most likely will be yes, I want to know have that information. So we're going to keep track of that account as well by specific identification of everything that we have in that account. Same thing with the outstanding liability that we have. That will be accounts payable in this case. Do I want to know how much is my accounts payable in total? Yes, I want to know that. Do I want to know how much I own for the credit card, for the utilities, to BC Hydro, for Telus, for internet, for Rogers, for cell phone, for Fido, for cell phone? Do I want to know that information? Yes, I do. So for that reason, we're going to keep track of every single accounts payable in the company, and we're going to put those one in account. Every time when we have a transactions which is related to the cell phone or for the expenses related to the cell phone, when we use the cell phone, that's going to become expense, we're going to put it in different account. And all the accounts, since they're all together, we're going to bind them. We're going to say this is our ledger. And again, on the top of the ledger, we're going to have a list. Cash, that much. Accounts receivables, that much. Accounts payable, that much. So far, rent expense, we paid that much. For the telephone expense, we paid that much. And you know everything at the front page. So if you want to get a little bit, why I'm paying that much for the cell phone? Open the account for cell phone, see what's happened there. And that's how we're organizing the accounting. That's how the whole accounting is done and organized and put together in one place, so people can get more information of what exactly happened and from where that balance came from. Once we have that organization, we said the assets always going to start with 1, liabilities with 2, owner's equity 3, revenue 4, 5, 6, 7, 8 is reserved to expenses. And once we have that, we come up with the idea that we want to do double entry accounting, which double entry accounting is firstly created by Luca Pacioli back in Italy. Interesting with Luca Pacioli was he was not only scientist, but he also was a monk. And his idea, the whole idea with the accounting was come to the point to help people to know what they have, where they have it, and what's the value of what they have. That was the whole idea, just to make it more easy. So when you have transactions between one person and another person, they to know what they get, what they give. That's why we have this double entry, and double entries always represents debit and credit. That means did you get something and what you give. Now, based on that, we're gonna remember that since we have assets is equal to liability, that means assets on the left side of the equation. If you draw this T account from the basic accounting equation, we're gonna see that assets gonna fall on the left side and liability and equity gonna fall on the right side. Left side, remember, is always debit, right side is always credit. So that means the asset's always gonna have a debit balance, or they're gonna increase every time when we debit on the assets. On the debit side, they're gonna increase, and liability and equity opposite. They're always gonna have a credit balance, and they're always gonna increase on the credit side. So that means on the other side, they're gonna decrease. Having that in mind, we end up with extended explanation of the assets, liability, and equity, knowing that the equity always increase when the owner invests from the owner's capital, always decrease when the owner withdraw money, and then we have to compare revenue and expenses. Since the revenue increasing the owner's equity, revenue always going to be with credit on the credit side. And since the expenses reducing the owner's equity, the expenses always going to be on debit side. Withdrawal also going to be on debit side since they're reducing the owner's capital. And then we start doing this transaction. From where we're going to find that transactions, for what will be the source that we can identify is the transaction related to the business or not. That will be the initial document that we're going to receive. Is going to be purchase invoice, is going to be sales invoice, is going to be bank deposit slip, is going to be bank check that we're paying the outstanding amount on the purchase invoices. That's a different story, but each of those documents is going to tell us, is this transaction actually related to the business? And if it's related to the business, we have to record it. If it's not related to the business, we're going to ignore it. And we started with journal entries on the T accounts. So now, knowing that, let's go and go back to chapter 1, and let's try to do all the transactions that we have on chapter 1, which we haven't finished. Let's try to put those transactions, record those transactions, and present them through the accounts and prepare the trial balance. The objective is to get this type of format of statement, which is called trial balance. So let's go one after another. First, for simplicity and for usefulness, I'm going to open this Excel spreadsheet. I'm going to open one Excel spreadsheet, which later I'm going to give you access to that Excel spreadsheet, obviously. And on that Excel spreadsheet, I'm going to start plugging some of the slides. Let me share that Excel spreadsheet with you so you can see it. And I'm going to start copying and pasting the slides directly here to the Excel spreadsheet. Again, I'm taking the slides from chapter 1, which explain the transaction that happened in the company. Can you guys see my screen? Okay, so let's go one after another. Let's try to journalize those transactions, put it as a format of debit and credit. Number 1. Remember, let's go with the owner of the company invested in the business, to start the business, $250,000 cash. What's happened? Is this first related to the business? Obviously, yes. So what the business get here?
Capital,
Capital, yes, they give you the capital. In form of what?
an investment,
Investment will be the person who investing. The business not investing. Business doesn't have anything to invest. What the business get? Cash. Yes, the business get cash. Let's get the cash. Debit cash. That's what's happened in the business. The business actually received $250,000 cash. From whom? From the owner of the company. So we're gonna get the cash in the bank account, $250,000 in the business bank account, and we're gonna show this as a increase of the owner's capital. So we're gonna show the credit, which credit will be owner's capital, and we're gonna show the business gonna show that at this point the business owe to the owner of the company exactly the same amount, $250,000. Why? Because the owner decided to invest in the business. So $250,000 coming here. Now, is asset equal to the liability plus equity? Do we have our accounting equation in balance? Okay, yes. Do we have debit equal to the credit? Yes. So we are perfect situation. Now let's go and see what's the next transaction. The next transaction is the business purchase a land for future office location and pay $100,000 cash. So let's see number 2. Again, what the company get? Land. Let's get that land. Debit, land. And they get $100,000 worth land. Perfect. Did the business pay for the land? Yes. How they pay? Cash. So we're going to reduce our cash. $100,000. Tricky question. Is the purchase of the lands going to affect our total capital? No, sorry, total assets.
no,
No. How much was total assets before we purchased the land? 250. How much is the total assets after we purchased the land?
250,
250. Make sense? We converted one asset to another asset. So the total asset is still the same. So now let's see the next one. Next one, it says we buy stationery and office supplies, and we agree to pay $7,000 in 30 days. So question is, what did we get? What the business get? Supplies. There we go. Office supplies. We can go office supplies. And how much we get office supplies? $7,000. Now the next question is, did we pay for those supplies? No. The following question will be, do we have to pay for those supplies? Yes. What's that for us then? Payable. And how are we gonna define it? Like a accounts payable. And that will be accounts payable for office supplies. If you wanted $7,000. As you can see, debit equal to credit. Now we have assets on one side and liability on the other side, which asset is equal to liability. Accounting equation is balanced. Everything is balanced. So let's see next one. The business earned service revenue by providing environmental consulting services for clients. Now assume that the business earned $30,000 and collects this amount in cash. So the business provides the service and collect the cash. What the business get? What the company get? $3,000 cash. Okay, let's get the cash. So that will be number 4 here. Let's get the cash, debit cash for $30,000. Now the question is, why the business get the cash? Because the business provide the service. Make sense? So that will be service revenue. So we once providing the service, that means we providing service to the customers. That means pure revenue, credit revenue, service revenue. Who's going to be affected by this revenue? And
Income.
that will be income. Definitely going to be income. But who's going to be directly affected after that? The owner of the company, correct? That's why he opened the company to provide service to the clients. So every time when he provides service, his capital is going to start increasing. So let's go $30,000 service revenue, which later is going to affect his capital, but we're going to see how that capital is going to be affected once we deduct expenses, if there's any expenses. That was the first 4 transactions that's happened. Let me grab the other 4 transactions from the slides from chapter 1, and we're going to continue with the next portion of the journal entries. How do you feel so far? Anything scary? Are you feel okay with these transactions? So this is what you have to do on the test next time. In class, one of the questions is going to give you transactions that happen. Owner invested capital, purchase supplies, didn't pay, after that pay, and this and this and this. That's what you have to do. Simple debit and credit. That will be one of the questions. That's why we're practicing this one here. So let's go number 5. So now, watch this. The business performed consulting services to the client who didn't pay immediately. In return of the service, the company issued the invoice and the client will pay within 1 month. Maybe. So let's go with here, 5. What's happened here? Explain to me, what's happened in this transaction? We have to collect something. Why we have to collect something? I cannot even say it better. We provide the service, which create a revenue, for which we haven't been paid yet. Are we going to get paid later? Hopefully, right? So what we're going to do, debit accounts receivable in this case, which will be 25,000. And credit, which account we're going to be create? We can repeat the same account on the previous transaction, which will be service revenue. I'm just gonna go and copy and paste it here, service revenue. For the same amount, 25,000. Now, let's watch this. Now, during the month, the company paid $12,000 in cash for office rent, employee salaries, and utilities. So we're paying everything cash. So 6. What's happening in 6? Rent expense, debit. Remember, expenses always debit. Rent expense, $4,000. Did we pay for that rent expense? Credit cash, $4,000. Next one, 7. What's happening number 7? We pay our employees. What will be that for us? Salary expenses. Now, watch this. Salary payable will be if we have to pay them. Make sense? Did we pay them? Yes. Did they get the money? Yes. Did they? Why are we paying them? Why are we paying the employee? Because they work. Once the employee work, can we sell the product of their work? Yes. That's why a salary expenses is part of the expenses of the company. Because whatever they did in the month or the period, we can sell it as a service revenue. We're providing service to our clients, which service is provided by our employee. Since the revenue comes from that particular expenses or that particular employee, the money that we're paying for that employee become an expense for the company. Imagine this. Let's imagine for a second. Okay, we're providing service to the clients, right? We're generating the revenue. We're paying our employees, but we're not recording as expense. Where are we gonna end up? Having revenue without expenses. So imagine we already generate $55,000 revenue, correct? $55,000 we have revenue. And we pay $4,000 or $6,500 for our employees. But we're not recording that as expense on how much we have to pay the taxes on the 55. Is that fair? How would we know if how much the business make if we don't recording those expenses? Make sense? So for that reason, we're gonna put here debit, salary, expenses. And did we pay those people? We did. We pay them. And how we pay them? Cash. Let's reduce the cash with the same amount, which is $6,500. Okay. Let's go with number 8. What's happening number 8? Utility expenses. Yes, that's correct. Debit, utility. 1,500. Did we pay for those utilities? Yes. Credit will be cash, 1,500. So one thing that I want you to see is in all those transactions, is there anything similar? What is the similar thing? Is there anything similar? Or if there's something similar, what is it? The expense transaction, Okay. But is there anything exactly the same? I wouldn't say similar, I want to say exactly the same. Is there anything which is repeat in all those transactions? Credit. Can you see? All the transactions going to different debits, but all the transactions go to the same credit. Can you see that? For the credit, we're using exactly the same amount. Sorry, not amount, the same account. So which account we're using? Cash, 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 cash. So for that reason, what we can do is I can get this entry and I can do combine entry. In the very beginning, I don't want you to do that. I want to keep it simple. But at the same time, I want you to know that you can do combine entry. What will be the combine entry? Grab the debits only. Only the debits. And what will be the logical thing? Use the same credit. So credit, cash. But now remember, debit has to be equal to credit. So what will be the amount of the cash that we have to credit? $12,000. That will be alternative entry of this entry. All those three entries. So instead of making three entries, you can do only one entry, journal entry, which is going to be called combine in journal entry. Why? Because all the credits going to the same account. Make sense? Now again, in the very beginning of this course, I don't want you to do that. I want you to stay with the simple entry debit, credit, debit, credit, debit, credit. But later on, you're going to see if I have the same credit account, why just don't combine everything and put it in the same credit? Okay. So now let's go with the other three transactions, the other set of transactions, which is from the slides. I'm gonna go back to the slides and I'm gonna grab the other transactions. Post them here. And let's work with those transactions, see what's happened in those three transactions. Four. Let's start again. First, the business pay $5,000 for this to the store from which they purchase 7,000 worth office supplies in transaction 3. So let's pay for this office supplies. Now the question is, did we get initially the office supplies? What would you say? Did we get the office supplies? Yes. Did we pay for the office supplies? No. Do we have to pay for the office supplies? Yes. So now we're paying. Let's pay for the office supplies now. Debit. Which account I'm going to debit now? Careful here. Accounts payable. What's going to happen if I debit liability account? Am I going to increase the balance or decrease the balance? Decrease the balance. For that reason, we're debiting accounts payable. So we're reducing the payable. How much are we going to reduce the payable? I own 7,000. Now I'm paying 5,000 only. Okay, my payable going down. What else I have to reduce? I have to reduce my cash. Debit, credit, cash. Make sense? So on the separate question is, don't get confused when you're paying for the office supplies. Make sure you understand when you purchase the office supplies and you don't pay for the office supplies, and when you're paying the office supplies. Those are the two different events. In the first place, you're getting the office supplies, you don't pay for it. And the second event, you're paying for the office supplies, but do you are you going to get new office supplies here for the $5,000? No. Make sense? We're not getting new supplies. We're paying for something that we haven't paid yet. So let's see number 10. Lisa decided to remodel her home for cost of $30,000 paying cash from personal funds. What do we have to do here? Number 10. Now, listen carefully here. If you see something like this, which is clearly not for business, or clearly there shouldn't be any transaction here, tell me that there is no transaction. Don't leave it blank. If you leave it blank, means that you don't know what to do with it. I want you to write me something. No transaction or not applicable or simply no. But write me something. Show me that you understand that there shouldn't be anything here. Communicate with me. If you communicate with me, I can give you the marks. If you leave it blank, I don't understand. Do you know that you have to you don't have to do anything?
Sorry, can you repeat that last one, the number 10?
Number 10, if you
Yes,
see
please.
transaction, she's remodeling her home for cost of $30,000 cash from personal funds. Now the question is this transaction related to business?
No.
No. Do we have to do the journal entry?
Well, no, because it's not with business funds.
Exactly. So make a note, tell me no transaction, no applicable, no journal entry, or just simply no. Write me something so I can see that you understand that you don't have to do anything. Okay, what if she do the business funds? That would be interesting question. What if she used the business funds for her personal expenses? What do you think we have to do in this case? Eventually, she has to return the money, but let's pretend that she has no intention to return the money. From where is she getting those? So, did she get the salary? What did she give in the very? No, listen. You cannot fire the owner, right? That like a owner will not fire the owner, right? That's not going to happen. Let's put it there. But let's go back in the very first place. Did she give something in the very beginning? And what we give her, what the company give her? Can you see it? We give her owner capital. So if she take cash from the company, What we gonna reduce? We're gonna reduce the cash. What else we gonna reduce? Capital. But can we reduce the capital directly? No. What we're gonna do then, in that case, if the she taking the money directly from the company, no, withdrawal. So watch this. Expense is when it's related to the company, right? In this case, we it's not related to the company. So it's going to be owner's withdrawal, debit owner's withdrawal to reduce her capital, credit cash. Good job. Good question. Good job here. Okay. Let's go with the next one. 11. Now the business collected $15,000 from the clients as a partial payment for consulting services in transaction 5. So in transaction 5, what we did in the transaction 5, we provide the service for 25,000, which we haven't paid yet. Now would they pay us? How much they pay? Did they pay the entire amount? So what we're gonna do number 11? What we get? What the business get? Cash. Let's get that cash. How much cash we get? $15,000. Yes, let's get the 15. Why are we getting the cash? Because the client pay. Hold on a second now. Client pays. Did we provide service to the clients in this transaction? Are we providing now service to the client? Yes, we provide the service before. Back here on this transaction, yes, we perform the services. I agree with you. Here we provide the service, the client didn't pay. Now the client pays. We're getting the cash. And right now, are we providing service to the client?
No, you're not.
No, we're not. Make sense? What we're doing here, we're collecting the cash that the client didn't pay us in the first place. That's what we're doing. Make sense? Does this
Yes.
make sense? So let's reduce. So now let's reduce the client receivables. Credit, account, receivable, accounts receivable, for the same amount, $15,000. Does that make sense for everybody? Because watch this. Let's play a little bit with the numbers here. I think we have time. Let's play a little bit with the numbers. So, in the first place, we provide the service, we collect in cash, 30,000, right? That's our revenue. In the next one, we're providing the service. We didn't collect the cash, but that's another $25,000 revenue. Now let's up to this point, 55,000, correct? Up to this point, we're $55,000 total revenue. Now, let's pretend in this transaction, let's pretend we collecting cash and we put it on the revenue. How much is my revenue now? My revenue is 70,000. The question is, did I provide service to my clients for $70,000? And what's going to happen at the end? When you're preparing financial reports, Canada service, because there's another revenue thing that's also chasing your revenue, which is called Service Canada, Canada Revenue Agency. they're gonna ask you, how much is your revenue? So if you put in here revenue again, you're gonna tell them my revenue is $70,000. But did you provide the service for $70,000? No, you haven't. You provide service only for 55. What's gonna happen next? I can tell you what's gonna happen next. Every Christmas, Service Canada is gonna start sending you a postcard and say, "Thank you very much for the extra taxes that you're paying for the revenue that you don't have." Keep doing the same thing. We are very happy of your mistake. Do you want that to happen? Hell no. So then when you're collecting money from the client for the service that he haven't paid, don't go with revenue again because it's not revenue. You're just collecting something that you didn't collect in the first place. And record the service that you actually provide to the client. Make sense? Don't forget this. Otherwise, again, Canada Revenue is going to start sending you Christmas card every Christmas. Say thank you very much from the extra cash that you pay us as a taxes. We can spend like a $10 to send you one postcard. So let's go with the number 12. What's happened with number 12? Now Lisa withdraw $6,000 for personal use. So you can see now we're going back to this transaction, number 10, but in number 10, she used the personal funds, when the number 12, she actually took the withdrawal for personal use from the company now. So what will be here? Debit, owner's withdrawal, and credit. What should take? Cash. For how much? For $6,000. Okay, those are our journal transactions, right? Those are our journal entries, if we can call it journal entries. So now what we have to do, the next thing that we have to do is all of those journal entry, we have to put it in the account. In accounts. So how many accounts we're going to have? We're going to have cash account definitely. One. We're going to have capital account. Two. We're going to have land. Three. Office supplies. Four. Accounts payable. Five. Revenue. Six. Receivable. Seven. Expenses. Eight. Another expenses. Nine. Another expenses. 10. Payable. Those repeat themselves. No transaction. Nothing. Those repeat themselves. And the owner's withdrawal will be the last one. That will be we're going to have 11 accounts. So let's create those accounts. Very simple. I'm going to create those one. You don't have to do anything. Just following me here. And then I'm going to post this one Excel spreadsheet to you, and you're going to have access to it. Just give me a second to find out where do I have proper accounts so we can actually use those type of accounts and start creating one after another. Okay, you can still see my screen, right? Yes. So let's start creating those accounts. I'm going to paste in those accounts. First, we're going to have cash. You can see the cash account, right? And that will be that will not be here. Sorry, let me do another posting here. Let's post it special like a values, and let's see what's going to happen to the values. No, I don't want that. So this one is better. And that will be our cash account. So what I can get rid of here is that this. I'm going to delete this one and I'm going to leave it the way it is. So what we can see, this account is for the assets, cash, which assets start with the debit balance, finish with the debit balance. We're going to have all the beginning balance plus the total debits in one place and all the credits on the other place, and then we can calculate the ending balance for simplicity. So how many asset accounts we need? First, we need the cash. Then we need another asset account for the land. So let's duplicate this cash to become a land. And I'm going to change the name here, land. Then I'm going to get, once I have the land, I'm going to get the next account that I need. Asset account will be office supplies. Going to move here to copy this one, and I'm going to get the office supplies here. Once I get the office supplies, obviously the next one that I need is accounts receivables. And I believe that will be the end of my assets. Accounts receivable, and I'm done with my assets. Now I have to start creating the liability accounts. Liability accounts, I have only one liability account, which is accounts payable, which we haven't paid. So let's get that accounts payable account. Will be accounts payable. And we have the accounts payable. Again, I'm going to get rid of this line only. And we're going to have debit and credit. Probably I don't need that many lines here. Let me delete those lines. And I don't need that many lines here that we can delete those lines. If we need more lines, we can add it later. Probably for the cash, we need more. Let's insert a little bit. Only for the cash, okay. We have the accounts receivable, accounts payable. Then we need the equity account, which is the owner capital. Then the next one that we need is the owner's withdrawal. But the owner's withdrawal gonna look like a debit because the normal balance on that account will be debit. We need that type of account. That will be owner's withdrawal. Once we get the owner's withdrawal, now we can start working on the accounts that showing the revenue and expenses. For those accounts, we're not gonna need the ending balance because those accounts naturally they don't have a balance, but we're gonna talk about this a little bit later. For now, just remember it. So let's paste here revenue. We're gonna have a revenue account for our revenue. Let me add one line here to be in balance with the other one. Push down. Okay, like this. The revenue. Then we're gonna have expense accounts. And we're gonna need a little bit more expense accounts. So I'm gonna copy those one and I'm gonna flip it right here. And we're gonna see how many expense accounts we're gonna need. I believe we need one more expense account. And once we have our accounts, now we can start. Now we have the journal entries on the first one. This one will be our general ledger. Why? Because we have all the accounts on one place. Now what we have to do, we have to post the transactions from journal entry into the general ledger. Make sense? Do you understand this logic? Okay, so let's start with first thing. In the beginning of the very beginning, let's pretend this is beginning of the month. What was the balance of the cash before the companies start any activities? When we just register the company, what will be the balance of any accounts? Zero. So first balance is zero. No questions about it. Let me make those one number sign and this one's number. And the beginning balance is always zero. You have to understand this. Office supplies, beginning balance zero. Accounts receivable zero. Now owner's capital credit balance is zero. Accounts payable credit balance zero. And everything else is zero, zero, zero. Withdrawal, there's no withdrawals, zero balance. Or revenue expenses, those they don't have balances, so we don't have to worry about that. So once we're done with this, let's start following the transactions. First transaction, we have cash. So cash increased with 250, capital increased with 250. So what we have to do is come here and says from number one, we get $250,000 cash. And yes, all the assets, liability, and equity accounts gonna be beginning balance gonna be zero. Why? Because when we open the company, there's nothing. Do you understand this? When we create the company, when the first we creating the company, there's nothing. And after that, the first transaction most likely is the owner invest the money in the company. Which what's happening is here is he invested $250,000 cash. So let's affect the cash. And which the other account that's going to be affected? Owner's capital. That account's going to go with up with $250,000. That's from number one. Make sense? Do you understand this logic? Are you guys with me? Or it's getting too much? Let's go with the next one. Now exchanging the cash for land for $100,000. So what's happened here? Now our land from number two, our land's gonna go up with 100,000, and the cash is gonna go down with 100,000. That will be in transaction number two. Then we're gonna go to transaction number three, and we're gonna see office supplies going up with 7,000, but we're not paying, so accounts payable is gonna go with 7,000 up. So let's show this one in here. Number three, office supplies, 7,000 going up. But from number three, that's accounts receivables, accounts payable, number three, accounts payable going up with $7,000. Next one, number four. We get the cash and we provide the service. So let's go here and get the cash. Number four, we get cash 30,000 and our revenue, number four, increase with $30,000. So number five, revenue also again increase with 25, but the client didn't pay, so accounts receivable is going to increase with 25. So in this case, number 5 will be 25,000 for the accounts for the revenue going up, and accounts receivable here from number 5 going up with 25,000. Next transaction will be all this. We're paying for the rent expense, salary expense, utility expense. So let's get those one. First, we're gonna pay rent expense $4,000. We're gonna have here rent expense $4,000 from a transaction number 6. Now from transaction number 7, I'm gonna have salary expenses. Let's get those salary expenses. Which was 6,500. 6,500. And the last one that you have is the utility expense from 1,500. 1,500 dollars. So that will be number 7, and that will be number 8. And we already know that in total we paid $12,000 cash, which is related to 6, 7, and 8. $12,000 cash. So now next thing that happened is we paid for the supplies, so we cleared 5,000 from the accounts payable, but we use cash. That number 9. So accounts payable, we clear 5,000. That's transaction number 9. But that reduce our cash 5,000, number 9. Let's put this one here, one below. So it can be on different lines, just for the chronological order. Next one will be no transaction. Since she took her own money to buy her own stuff, we don't care about personal matters with the owners. Next thing, we collect cash from the accounts receivables, 15,000. So our cash gonna go up with 15,000. Sorry, not 25, 15,000. That was number 11. And accounts receivable is gonna go down with 15,000 with number 11. Now the next thing that happened in this company is she withdraw $6,000 cash. So in this case, probably I'm gonna insert one line here to show this reduction of the cash is $6,000. That's transaction number 12. And withdraws $6,000, increase in the withdrawals. Now number 12. So once I'm done with this thing, what do I have to do? I have to calculate how much is the beginning plus all the debits. Then I have to calculate all the credits. Once I do that, then I can see how much is my balance. So if I run this calculation, I'm going to find out that I have $172,000 cash. Why? Because owner invested 250. I collected 30,000 from the service first revenue, 15,000 from the second, that's 295. And I spent 100,000 for the land, 12,000 for the expenses, 5,000 partial payment on the office supplies, and 6,000 withdrawal from the owner. Now let's see what's happened in the land. Land, there's only one transaction. So in that case, that will be my, sorry, probably gonna copy this, the entire section. So my total beginning balance plus the debit is 100. There is no credit, so the balance on the land is $100,000. Office supplies, same idea. On office supplies, first I'm gonna calculate beginning balance from all the debits. Then I'm gonna get all the credits. That will be zero here. And then I'm gonna get the calculation debit minus credit. And it's gonna give me that I have $7,000 worth office supplies. Then I'm gonna do exactly the same for the accounts receivables. And I'm gonna find out that accounts receivables, that's not zero here. We're gonna delete that one. My accounts receivables in fact are $15,000, which give me $10,000 more to collect. Let's bring this one down like this. So now I can use this calculation here. Now accounts payable. For accounts payable, I have to be careful because now I'm the opposite side of the equation. So normal balance here is credit. So I have to get the beginning balance plus the credits plus the debits. Get the debits. Probably they'll be okay. This one is works. And then I'm gonna get credit. That will be equal to credit minus the debit in this case. And I'm gonna see that I have outstanding accounts payable for $2,000 left. Same thing I'm gonna do with the capital, and I'm gonna see that I have only capital 250. Now the next thing is for the owner's withdrawal. For the owner's withdrawal, I'm gonna find out that there's only $6,000 here. For the revenue, I'm gonna flip this one, and I'm gonna see that I'm generating $55,000 revenue. Now for the expenses, I can flip those formulas here: one expense, second expense, and third expense. So now what I have is on one sheet, I have all the accounts with all the transactions that happen in the accounts and the ending balances for every each of the accounts. Make sense? That's my journal ledger. Now the next thing that we have to do is the trial balance. For the trial balance, what we have to do is we to put all the balances of all the accounts that we have on one place. How are we going to do that? Very simple. Again, I'm going to use the next worksheet and I'm going to post something like this. And we're going to have the trial balance. The first thing on the trial balance is the company name. Then we're going to have name of the report. And the next one will be for what period we're preparing this. That will be for the month ending or ended, let's say May 31st, year 2 something 5. So what we're going to have? We have to put all the accounts that we have. So we have the cash, we have receivable, we have land, we have accounts payable, we have owner's capital, owner's withdrawal. There's no service revenue. Then we have rent expense was the first one. Rent expense. Then we have salary expense. And then we have one more expense, which is utilities expense. So what we have to do, I have to put all the balances here. How am I going to do this? just gonna go to the accounts and I'm gonna just flip the balances, the ending balances only. So I have $162,000 cash, accounts receivables. Gonna go find accounts receivable account, which is right here. Oops, I have one more account here, which is office supplies. Let's include it. Office. Let's get those office supplies as well. The office supplies is equal to here, office supplies is $7,000. Then I have the land, $100,000 land. Then I have accounts payable. Accounts payable, don't forget the balance is on credit side. So we have to put it as a credit. Accounts payable will be 2,000 left. Owner's capital, we're gonna see 250,000. Then we have the withdrawal, which is with debit balance. We're gonna put the owner's withdrawal here. Then we have the service revenue, which is with credit balance, $55,000. Then we're gonna have the expenses, which expenses first we have the rent expense, and then we have the salary expense is the next one. So sorry about this. Let me change those two. Actually, this one. I want this one temporarily here. I'm gonna go V, and this one's gonna go here, and this will disappear. So the salary expense is my second expense, which was $6,500. And the last one is the utility expense with $1,500. So once you do this, that will be your trial balance, the trial balance for the company. What will be interesting? Let's get the totals. Once we get the totals, we're going to see that total debits are 307. And if we are correct, we should get exactly the same amount for the credits. And since we're getting it the same amount, that means we are in balance. That means every time when we did transactions, debit was equal to credit and everything is perfect. Now, once we get the trial balance, the next thing that we can do is simply to tell the owners what's the income, how much is your capital, and what you have as assets, liability, and equity. So we can prepare those simple statements. That will be a trial balance here. And the last thing that will happen is the statements, financial statements. So how are we going to do the financial statements? I'm going to copy one template that I have, and we're going to start plugging this information. So the number of the company is different. What was the name of the company? The HEC. Let's change the HEC company, and that's going to change here. Let's change the statement here for March, so we'll be in the same reality. So I don't have to change everything. March 31st. Only the year is going to change here, X5. Okay, so then we're going to start with the first, which first is from the trial balance. I'm just going to grab it and was service revenue. Then I need one more expense. I'm going to insert one more line here. So my first expense here will be from the trial balance will be rent expense, and then I'm going to just drag it down and I'm going to get all the expenses that I need. So what do I need? My service revenue was from the trial balance was $55,000. Then I have my expenses. My first expense is $4,000. Second expense is $6,000, and the next expense is $1,500. In total, I have my total here will be this plus this and plus that. My total expenses are $12,000. So my net income from my operation will be this one minus total expenses, which will be 43,000. So on those two numbers, I don't need the dollar amount. Presentation purposes, I'm going to leave it like this. So now I know how much the business generating for the period of time that we have those transactions. The business generates $43,000. Now the next thing that we have to do is, this is what you have to do. This calculation you have to do on the test in class next time. You don't have to prepare the statement, but you just have to show me that you can calculate the owner's capital. So how are you going to start? First, you're going to start with beginning balance. How much was the beginning balance when the company is created? Remember, if the company is just created, beginning balance will be zero. Always zero. So what's the next thing? We're going to see how much the owner invested. So we're going to check here on the balance how much is the investment. Since the investment is exactly capital, that's going to be directly 250,000. In total, at this point, is 250. Now, did the owner withdraw money? In this case, yes, he did withdraw money. How much he withdraw? We're going to go here to the trial balance. He withdrew 6,000. And the next thing is we're going to check if the company has net income or loss. If it's a net income, we're going to add the net income. And since we have the net income, we can clearly see it. How much is it? $43,000. We're going to bring it here. So our mid calculation here will be 43,000 minus 6,000. So the net increase in the owner's capital is 37. So the total balance it's not going to be 37, it's going to be a little bit higher. So the ending balance of the owner's capital is $287,000. Now that's how much the owner's capital is. Once we close the revenue, expenses, and owner's withdrawal. The owner's capital is $287,000. That owner's capital is going to become our equity. Now, what else we have as equity? Well, we have cash. Let's see what we have. We have cash. We have accounts receivables. We have office supplies. And we have land. What are the balances? For the cash, we have 172,000. Then we have accounts receivables, when we have supplies, and then we have land. Those two I don't want to have a dollar sign, but I want to be no dollar sign with normal numbers. So my total assets are equal to $289,000. What else the company has? The company has liability. How much is the liability? Accounts payable is $2,000. Total liability obviously will be exactly the same amount, $2,000. Also, the company has the owner's capital, which is the equity, the only equity the company has. So the total liability and equity is $289,000, which is exactly what I want it to be in order the accounting equation to be in balance. This one will be assets and 5. And that's how you're going through all the process from the journal entries based on the transactions, posting all the journal entry into journal ledger, which including all the accounts. From that journal ledger, you're extracting only the ending balances, which presents your trial balance. And from the trial balance, you can prepare the statements. First statement, remember, always is the income statement. Because the first thing that the owner of the company wants to know, and you want to know, am I making money on my business or not? So, where's my revenue? How much are my expenses? Once you find out, you're going to ask, well, Okay, I can see the company generating the income. Where's my capital? How much is mine? And you're gonna say, okay, from the capital that you first in the beginning, the very beginning, always gonna be zero. And then you're gonna start. You invested that much, plus you company business generating for you $43,000, which increasing your capital. That's why you open the company to generate that money. So you're generating, your capital goes up. But you withdraw 6,000. So the net increase is only 37. Why? Because from the 43,000 that business generating, you already took 6,000. So right now in your capital account, you have $287,000 to get from the business. Okay? So I have $287,000 that I can get from the business. Where those money are? Well, you have $172,000 in cash, 10,000 in the accounts receivables, office supplies you have 7,000, and land $100,000. In total, you have 289,000 assets worth assets. From those assets, once you pay the $2,000 liability, everything else is yours. Make sense? So now the question is, do you have to manually prepare all this like worksheets? And the simple answer is no, you don't have to. Once you enter the journal entry, accounting software automatically is going to prepare those, is going to post every time when you put in here journal entry, the accounting software knows, okay, I have to put in cash 250, I have to put the capital 250. You're buying land, okay, I have to flip cash from the cash into the land for $100,000. If you buy supplies, okay, I have to increase the supplies, and since we're not paying accounts payable. So the accounting software automatically doing those posting on the general ledger. Accounting software automatically on one sheet extracts the ending balances for all the accounts that you have, and once you run the trial balance report, it's going to show you this. And accounting software automatically prepare for you the three statements: income statement, statement of the owner's equity, and the balance sheet. So once you click on the statement shows up. So what you have to do, you have to do the only thing is see the transactions, identify the transaction, put it in the right places with the right amount. And then everything will be automatically posted, and the only thing that you need is the trial balance or the financial statements to see where you are. Questions now? Do you find this interesting? So what I'm going to do is I'm going to post you all this Excel spreadsheet. So what you can do is, if you want, you can try to recreate yourself something. The other thing that you can do is, once you have this Excel spreadsheet, so listen to me carefully. Once you have this Excel spreadsheet, make it interactive. Right now it's interactive, right? So financial statements read from the trial balance. That's one thing. The other thing is, you can use it for your personal accounting if you want to. What will be your revenue? Employment revenue. Everything that you're receiving as from the salary in your bank account, that will be your revenue. What will be your expenses? All the expenses that you're paying. And then you can see every month how much is the income that you're getting from your employer, how much are your expenses, and you know exactly, am I income, am I not income, where I am. Balance always going to start with zero. Now the question is, just to make it work, in the beginning you can put here your current accounting balance, and that will affect here and it's going to show us the ending accounting balance in the bank account. And once you have this, you can see, okay, I have that much in the bank. I have that much, obviously receivable will be zero. Now, office supplies, you're not going to have any office supplies. If you have any other assets in your life, you can put those assets here. Liability will be all the amounts that you're owing. So here the cash will be all the balances in cash that you have in the bank account. Liability will be liability. And then you can see the cash that you have minus everything that they have to pay. How much is mine? And that's mine. You can work backwards and that can flip for the next period. And the next period will be whatever you had from the previous period. That will be capital now on the next period. Whatever you get in the first calculation here, that will become on the next month, plus the income that's left for you. And that's, you're gonna see how that's gonna rolling. So basically you can do your personal accounting. The whole point is you to understand how much you're generating every month, where do your expenses, what kind of expenses you have, and once you generate the income, where that income goes. Is it increase my cash, or I'm increasing my cash but my liability goes too much too? What exactly happened? And you're always going to find out again. uh, The whole point is you to find out from where you're making money, on what you're spending your money, where the money are. Those are all the questions that every person wants to know. And once you have those answers, you're going to see, am I earning money or am I not earning money? All right. Uh, so let's go quickly over the slides. Let's cover the slides. And I'm going to show you the questions that are going to come next time on the test. I'm not going to show you exact questions. Don't get me wrong here. I'm not going to show you the questions, but I'm going to give you something similar so you can see what to expect. And then we're going to make a break, and then we're going to start with chapter 3. So let's go first with the slides, finish the last slides from chapter 1 after these transactions. So you can see how they're going through the transactions. So basically what we did now is we went back to chapter 1 and we did all those transactions one after another, but now in the lights of chapter 2 with the debit and credits. Once we did those debit and credits, what we did is we put the transactions in each account, right? Cash, accounts receivable, supplies, land, accounts payable, capital. But in capital, we break it into the withdrawals, revenue, expenses. Once we did that, we start preparing the financial statements. Now, one thing that we didn't do here, they don't showing, we first prepare the trial balance. Let me see from chapter 2, because they're having this trial balance from chapter 2. Yes, that's exactly the same trial balance, so I can easily copy this slide and flip it to the slides that we're using here. So what we did first is, after this, we prepared, let me paste it, we prepared this trial balance. That's exactly the thing that we did. With the balances for each account and exactly the same information. So once we have this trial balance, now we can start preparation of the statements. First, we're gonna again, remember, we're gonna prepare the income statement. The income statement always gonna be for the period of time. I'm gonna talk again about this for which statement, for what's the time frame that the statement is prepared. So income statement is for the period of time. Statement of owner's equity is for the period of time. Balance sheet is at specific point of time. Today and only today you have this balance in your bank account. Is it going to be the same balance tomorrow? We have to wait tomorrow, and tomorrow we're going to see what the new balance will be. It might be the same, it might be different. Why? Because the time passes, right? That's why you say, today I'm 30 or I'm 25 years old. How much will be tomorrow? Let the time pass, and then tomorrow I'm going to tell you how old I am. Because if the time stopped today, you're going to stay at 25. Okay, so once we prepare those statements, income statement again is going to look exactly what we did. 555 expenses, income. That income is going to go to the owner's equity, and we're going to have the beginning balance. So that's what I want you to do. That's exactly calculation that I want you to do on the questions that one of the questions that I'm going to give you is you to calculate me the ending balance for the capital. So remember, calculation will be beginning balance plus the investments plus the income, if there's income, minus withdrawal minus loss if it's loss. You cannot have income and loss in the same period. Either it's going to be income, either it's going to be loss. But if it's income, added to the capital. If it's loss, deducted. Withdraw, always deduction. And you're going to get the ending balance of the capital. That will be the only question. I'm not going to ask you to prepare me the statement. Statement is not required at this point. Just the calculation. How much is the capital? Beginning balance, investment, income, withdraw, total. And the last thing here for these slides is to prepare the balance sheet, which balance sheet again has the assets, total assets. Then we have the payables, and then we have the owner's capital. And that actually concludes chapter 1. I'm not going to spend time on the cash flow since we're not going to touch cash flow until you go to 1210. If you catch me on 1210, then we're going to talk about the cash flow statement, and I'm going to explain to you how to make the cash flow statement and prepare the cash flow statement. So that concludes the chapter 1 and 2. So you have all the information before you have the information, but I wanted you to see the transactions in form of the whole logical order preparation of the trial balance plus the income statement on the Excel spreadsheet, which Excel spreadsheet again will be available for you. Now let's go and I'll show you and I'll give you, so pay attention now. This is the time that we don't have to, no cash flow statement in this course, no. Again, if you catch me on 1210, I'm going to teach you how to do cash flow statement in 1210, which is the principles accounting second part. At this level, no cash flow. So let's go now and show you and pay attention. This is the important part now, which is going to affect you next time. Only 21 students left. That's okay. I hope this is going to pay back next time. So let me start sharing questions from you. Which question I'm going to share? I'm going to share question from Blackboard. So the questions that you're going to have, I'm going to find similar question that you're going to come next time. It's on the Blackboard. I already showed that question, but I'm going to show it to you again. So let's go to your course, which is section 5. And if you go to course content, chapter 1, Chapter 1. If you go to the cases for practice, and if you click on the question 1-2, when you open it, it's gonna come something like this. So what is interesting here? That's what the question will be next time. I'm gonna show you random accounts. I'm gonna give you random accounts. There's no order in those accounts. Now, you're gonna have, definitely you're gonna have expenses. Definitely you're gonna have prepaid expenses. Definitely you're gonna have a revenue. And definitely you're gonna have unearned revenue. So what you have to do is, the first thing, what I suggest you to do right now is, once you see the accounts, identify which account is what. Is it asset account? Is it liability account? Is it equity account? Is it withdrawal account? Is it revenue account? Is it expense account? Those are the 5 options that you have, right? Asset, liability, equity, withdrawal, revenue, expense. Once you identify that, the question is going to be, calculate me from the accounts that you have, how much is the total expenses? For the accounts that you have, how much are the total assets? From the accounts that you have, how much is the total liability? From the accounts that you have, how much is the net income? And from the accounts that you have, how much is the owner's capital at the end of the period? So basically, how can I answer this question? This is the question. How can I get the owner's equity at the end of the period? Well, what do I need? I need the capital at the beginning of the period. Okay, I have it. It's 0. What else I need? How much he invested? So the question, how much he invested? He invested 30,000. How much he withdraw? He withdraw 5. At this point of 25. What I'm missing? I'm missing net loss or income. How can I get it? Well, where is my revenue? I have interest revenue $2, and I have consulting fee earned $18. That's total $20. How much are my expenses? I have expenses 22. I have 22 is here, and that's the only expense. So I have $20 revenue, $22 expense. So I have $2 loss. So beginning balance was 0, 30 invested, 30, minus 5, 25, minus 2, so the owner's capital will be 23. That's what you have to do next time. Again, question for you. Prepaid expense, what kind of account is that? Asset account or expense account? Unearned revenue, what kind of account is? Revenue account or liability account? If you know this, you're going to be fine next time. If you know that prepaid expense is asset and unearned revenue is a liability, you won't have problem to make the calculations. So the other thing, this is one. So the one question is going to ask you for those different calculations. Again, that's why I spent more time on the calculating the owner's capital. The next question is going to ask you to do some simple journal entry, the one that we did today. Simple journal entry. Now, one of the questions that I have for you, based on the journal entries, I want you to pay attention because it's important. That means it's gonna come. Every time when I say it's important, that means it's going to show up. Where it's going to show up in the next test. So question is, let's go back to the journal entries here. I'm going to copy this one and flip it here, and then we can play. Now, question for you. Please pay attention. In this case, the owner invested capital, correct? And that capital was in form of cash. So the owner brought cash into the company. Can the owner bring another capital in the company which is not in form of cash?
Yes.
Yes. Like what? Give me example.
Equipment or land.
Equipment. Let's stay with the equipment. Let's pretend the owner invested. Thank you. That's a very good example. Debit equipment. Let's say equipment is $20,000. Company get the equipment. Owner give it to the company. Equipment. Which account should I create? So once you think about this, think about the nature of the transaction. Owner invested equipment for $20,000 in the company. What the company get? $20,000 of equipment. Did the company has to pay for that equipment? Did the company purchase the equipment? Did the company make any effort to get that equipment? No. Who gave the equipment to the company? The owner did. How this gonna affect the owner? His capital is gonna go up. That's it. Equity increasing. Thank you so much. That's what you have to do. Credit, owner's equity or capital. Make sense? So can the owner invest another thing? Yes, he can. There's another example here. What you said was land. Okay, he invested land. 3. Debit, land. Let's say $50,000 land. Again, did the business purchase the land? No. Who gave it to the business? The owner. So what do we have to do? Credit owner's capital. So what that means, owner can invest whatever he wants in the business. He can invest his own personal vehicle. He can invest his personal computer. He can invest his land, his apartment, his building, his whatever he wants to invest, plus some cash. If he don't have a cash, then you can sell the land and get the cash and start making the business. Make sense? Don't forget that. And the last thing is, again, don't forget when the transaction is not related to the company, please write me down. No transaction or no journal entry or no entry at all, whatever you want to write me. Cross it, X, 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 no, 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 whatever you want to write, just write, communicate with me in order to get your marks. The last question, so that, there will be 3 questions. So the one will be the simple journal entry like this. Second one will be the calculations, total liability, total equity, total this, total that, total capital at the end of the period. And the third question will be, I'm going to give you account, name of the account, and I want you to tell me to which financial statement that account belongs to. And you have only three options for you're going to have only three options for financial statements. And that will be either income statement, either statement of owner's equity, either balance sheet. So I'm going to ask you inventory, on which statement we're going to go? And you can tell me which statement. Rent expense, to which statement that account is going to go? Or revenue, to which accounts, to which statement that account? Owner's withdrawal, to which statement that account is going to go? And those are the three questions that you're going to see next time in class. Again, it's not going to be starting the class. It's going to give you the questions at around 2 o'clock. So let's have a short break and let's continue with chapter 3 now. How do you feel now? Is it getting better or are you getting more difficult? I'm trying to make it easy for you. I'm trying to make it more, even spending a little bit more time here and there to explanation, but I'm trying to make it understandable, easy, interesting, so you can actually enjoying this course and enjoying the accounting, because at the end of the day, it shows you a lot of things about what you have and from where that you have coming from. How actually, do you want a break, guys? Yes. How long? When do you want 15 minutes? Let's make it okay. When we starting then? 45 or 50? 3:45 or 3:50? 3:45? No, we haven't started recording yet. So let's go for the recording purposes. This is the chapter 3. In chapter 3, we're going to continue whatever we see from chapter 1 and 2. So we're going to continue with the analyzing the transactions, posting in the journal, showing the general account, ledger account, the general ledger, general accounts, preparing the trial balance. In chapter 3, we're going to see is there any adjustments that we have to do and prepare just the trial balance. So we're going to make sure that we're preparing financial information on the period of times. Period of time assumption will be that all the information has to be related to the period of time what the statement is related to. If it's for 1 month, that month has to catch only transaction that happened for that month or related to that month. If it's quarterly, all the transactions that happen in this quarter or related to that quarter. Annually, all the transactions that happened for that year or related to that year. And that's going to affect the revenue and expenses. So business going to prepare those periodic financial statements. So for that reason, we're going to have fiscal year, which is fiscal year is the operating year for the company or corporation. And then we're going to have a calendar year. Calendar year runs from January 1st to December 31st. Company or business can choose calendar year to be the fiscal year or can choose not to be. So for that reason, fiscal year is different than calendar year. Fiscal year end can be in one of the company that I'm working was July 31st. In the other company that I was working was September 30th. In the third company that I was working was October 31st. So each company choosing his own fiscal year end. So then how often we're going to prepare the financial statements? We can prepare it monthly, we can prepare it quarterly or semi-yearly. Which, if the statement is within the operating year, or the fiscal year of the company, those reports are going to be called interim statements because they're within the period. Let's keep going here. Now, why do we need this? Because we want to make sure that the revenue is recognized when it's earned, not when the money are received. So for that reason, for the recognition criteria for the revenue, we're always gonna record the revenue when the service is actually provided, or when the goods are actually delivered, or if there's a contract with the client, when the contract is performed. Now, the recognition criteria for the revenue will tell us when to record the revenue and what amount has to be recorded. Obviously, we can record it in the equal amounts based on the period when the revenue is actually earned. Simple example. Very simple example. I want you to think about this and I want you to tell me what do you think. First, when did you pay for this course? Before the start of the semester, or you have to pay at the end of the semester? Before. Okay, let's pretend you're the accountant of Douglas College. I'm the student. I'm paying you the fee for the course in April. Mid-April, I'm paying you for the course that starts in May and run from May to end of August. I'm paying you, let's say, $2,000. You're the accountant again for the Douglas College. Are you going to record this as a revenue or not? If you record it as a revenue, why? And if you not record it as a revenue, why not? What do you think? You get $2,000. I pay you $2,000. Is this revenue for you? Then the following question is, if you say it's a revenue, I'm going to ask you this. On April 30th, can I come to you and say, I changed my mind, I want to take the courses in UBC. Give me my money back. Would you give me 100% of my fee? Why not? In fact, I have 1 week from the start of semester, for which start of the semester I'm entitled to the 100% of refund. So again, the question is, so I pay you, you get the money. How is that receivable for you? Think about it. The simple question will be, so if you're saying this is a revenue for you, then the question is, when you're gonna recognizing the revenue? When the service is provided or when the cash is received? Based on what you see on your screen. When you're gonna recognize the revenue? When it's earned. Okay. When will be earned in Douglas College the revenue? When the service is provided. At the beginning of on the April 15, course start on May 1st and run till the end of August. Did you provide me any services? April 15, did you provide any services to me? No. Did you earn any of the money that I already pay you? No. So what was the two options for revenue? Either it's going to be revenue, either it's going to be, what's the other one? Remember? When you earn it, it's earned revenue. When it's not earned, what kind of revenue is? Unearned revenue. Exactly. What's unearned revenue? What kind of account is that? Liability account. What that means? That means simply is before you start providing any services, if I ask for my money back, you have obligation to pay me the money back because I, in fact, haven't received anything from you. Make sense? So if I prepare the, watch this, if I prepare the financial statements on a monthly basis, when I'm going to show my first revenue from the tuition fee that I paid you? Beginning of May, did I receive anything? Did you give me anything? Did you provide beginning of May, May 1st? How many classes already passed? Did you provide me any classes? Did you give me any questions? So why are you recognizing the revenue? So when will be the first option if I'm reporting on a monthly basis? On the monthly basis, think about it and tell me what you come up with some idea. We're making the reports on the monthly basis. When we're gonna make the report? At the beginning of the month or the end of the month? Which would be more logical? At the end of the month. So what will be the first period that I have to show some revenue? When the period's gonna end? It's gonna be end of May. Excellent. Okay. So now let's make it simple now. I'm paying you 800. The course, this course, let's say cost $800. I pay you $800. You have to deliver the course within 4 months. At the end of the May, how much revenue you're gonna recognize as earned and how much will be stay as unearned revenue? And how much is unearned? 600 unearned. At the beginning of May, now, how much is earned revenue? How much is unearned revenue? Okay. Earned revenue at the beginning of May? Zero. That's correct. Everybody understand this logic. So then the follow-up question will be, at the end of July, how much will be earned revenue? How much will be unearned revenue? End of July. The course run from May to August. End of July. Make sense? At the end of August, it's going to be 800 earned, 0 unearned. But if we have to be precise, at the end of the August, the revenue which was paid on April 15th is going to be all earned, but then we're going to have a new $800 sitting because for the fall semester, which run from September to December. Make sense? So they're always going to be rolling over. Okay, good. That's good. That's very good. Do you understand the logic of earning the revenue? We're going to earn the revenue when the service is provided, not when the cash is received or when the goods are received, not when the cash is paid. So let's see this one. There's some chart here. The person comes and asks for the advertising, which advertising start to running from January 1st. So the person who get the money say, thank you very much for the check. Your advertisement is going to start running on January 1st and going to run all the way to January 31st. At this point, do we have a revenue? On December 12th, do we have a revenue? And if you don't have a revenue, what we have? Because we get the money, we get cash, we debit cash. Which account is going to create? Unearned revenue, liability account. Now, on January 31st, the campaign finish, we put the advertisement, it's run everywhere. What's going to happen now? Are we going to have liability on that day, on January 31st? No. What we're going to have on January 31st then? We don't have unearned revenue. We're going to have earned revenue. Yes, we have earned revenue. That's correct. No more liability. Revenue from unearned become earned. Excellent. So now let's go with the next one. Expenses. When we going to recognize the expenses? Now, the simple way is we have to match expenses with the revenue within the same period. If the month of January we earning the revenue for the advertisement, all the expenses related to that advertisement has to be included in the same month, regardless where we're paying the expenses. So imagine this. Electricity that I have to pay for the electricity for advertisement. But the electricity bill comes in February. When the February bill comes, which the February bill's electricity is for January, for which period that expenses I should record it? In January or February? In January, because that bill is related to January. Make sense? When you're going to receive the bill, it's irrelevant. The question is, for which period that expenses are related to? If they're expenses for January, those expenses belong to January, and you're going to record it in January. Do you understand this logic? Because you're trying to match revenue with expenses. And since the electricity that you use in January was related to the revenue that you generate in January, you have to match those two. For example, let's go with something dramatic so you can understand this. In January, you're providing the advertising services. You're using the electricity. On January 31st, you're recognizing the revenue and you close the business. You're closing your business. That's it. You're done with business. I don't want to do this advertising anymore. January 31st is my last day of the business. Boom, done. Electricity bill comes in February, which electricity bill is for January, but it comes in February. How are you going to record it? On which period are you going to record it now? Is that electricity bill for February or for January? In January. Why? Because you close your business on January 31st. If you show that expense in February, that will be the only expense. So you're going to show me that in February you're losing money, but you didn't provide any services. How can you lose money when you're not providing services when you close your business? That doesn't make sense, does it? So for that reason, try to understand. And actually, don't try to understand, just kind of put it in your head. Always match expenses with the period for which revenue was earned or those expenses are related to. And match expenses incurred for the appropriate time for the rent expenses related in particular month. Now, for the rent expenses, you're paying upfront and then you're getting the services. Insurance will be the same. You're going to pay the insurance for the entire year and then you're going to receive the service. So we're going to see how that's going to work. So let's go with first definition of the expense. The expenses are cost of asset and services which are consumed to earn revenue. For that reason, we have to match the expenses against the revenue. When we have matched the expenses or revenue, we're going to see how much is the net income for the period. It's very important we to put everything together. Otherwise, we're going to get a wrong impression of are we making money or are we losing money. Everything has to be this together. Matching objective is to identify all the expenses which happen for the accounting period for which they are related to. When you receive the invoice is irrelevant. The question is, when did you receive the services? Did you receive the services or you have to receive the service later? We have to measure the expenses if you prepay early or if you have to pay late. And we have to match the expenses with the revenue in the same period. So we recognition the expenses is some of the expenses obviously cannot easily match the revenue. Rent utility examples. Those type expenses should be matched to the time period they're related to. Why again? The rent we're paying upfront, utilities we're paying after. But doesn't change the fact that those utilities are related to the previous month and that rent is related to the next month. So what will be next? Let's see what will be the accrual basis versus the cash basis accounting. Now we have two types of accounting. One accounting is every time when we pay the cash, we're gonna record the revenue. Expenses. And every time when you receive the cash, we're gonna record the revenue. Unfortunately, only Canada revenue works in this principle. We in accounting, in order to be accurate and in order to be comparable and actually to show the effect of all the transactions that happened on the period which are related to, we're using accrual base of accounting. What that means? We ignoring where the cash is paid or received. That's not our objective here. Our objective is, did you receive the services or the goods? Or did you pay for, or did you use the services and the goods? Where you're paying or where you're receiving the money, that's irrelevant. Again, we're chasing, did I provide the service or did I provide the goods to the client? Or did I receive service or did I receive the goods from the vendor? If the answer is yes, that creates a journal entry. If the answer is no, then no journal entry. When the cash is paid, it's irrelevant. So the adjusting process is important. Why the adjusting process is now we're trying to some extent, to apply this accrual basis accounting through the adjusting entries. Means at the end of the period, we're going to start thinking, is there anything that we paid for, but we haven't received the service yet? If the answer is yes, that will become prepaid expenses. The next question is there anything that we paid for, but the time has passed and we received the service? If the answer is yes, then we have to move it from the prepaid expenses into actual expenses. Same thing with the revenue. Is there any cash that we receive from the client, but we haven't provided the service yet? If the answer is yes, that's going to bring us unearned revenue. If there any cash that we received, but we provide partial services, if answer is yes, then we have to prorate it over the period of time, the way we did it with the tuition fee, and we have to show earned revenue and unearned revenue. That's what we have to do at the end of the financial period or the reporting period on the reporting date. So the adjusting entry will be, first we're going to measure the property of the period of time, which is the income statement for that period of time, and we're going to assign the revenue to the period for which revenue is earned, and we're going to assign the expenses for which period the revenue was earned or incurred to earn the revenue. And then we're going to update the assets and liability accounts respectively. So which type of adjusting entry we're going to have? We have two main types of adjusting entries. Adjusting entry for the cash that we already paid or the cash that we already received. But we didn't, for the cash paid, we didn't receive the service, and for the cash received, we didn't provide the service. And accrual means that we received the service, but we haven't paid yet. Or we provide the service, but we haven't paid yet. So you understand? So now the timing of the cash is irrelevant, but for those two entries, deferral and accrual, the cash is important here. For the deferral, we get the cash. The cash transaction already happened. But either the revenue expenses, they haven't happened yet. So what we're going to do, we're going to push them in the time. So we're going to defer. We're going to defer those ones. How can we defer something that we paid but we haven't received it yet? That will be prepaid expense. How can we push away something that we receive but we haven't provided the service yet? Unearned revenue. The other way is accrual. We received the service but we haven't paid yet. How can we show it today? As accounts payable. And the other thing is we provide the service but the client hasn't paid us. That will be accounts receivables. Make sense? So all the thing is in the first one. Watch this. On the deferral, cash is paid or cash is received. And we pushing the recognition in time. Either prepaid expense, either unearned revenue. On the other hand, we have to pay cash later. But we provide the service or we receive the service. That will be either accounts payable, either accounts receivable. So again, watch this. Again, we're going to have this category prepaid. Think about when you say prepaid, so that means you paid it and or you received the money, but service hasn't been provided yet or you haven't received the service. So that will be here you're going to use the technique deferral. You know that technique or you may know it. Sometimes when you want to push something in the future, you're going to defer it. I don't want to take the exam. I want to defer my exam. What that means, you postpone it in the future. Accrual means that you haven't done it yet, but you're showing it today. So on the accrual, we're going to have prepaid expenses. We're going to have, again, which accounting are prepaid expenses, unearned revenue, and we're going to have this account amortization. On the accrual, we're going to have accrue expenses, which We're going to accrue the expenses, but we're going to show us accounts payable, and we're going to have accrued revenue, and we're going to show it as accounts receivable in this case. So prepaid expenses, again, prepaid is an advance payment for the expenses which we haven't received yet. Perfect example will be insurance. In this case, we're creating the asset, for which asset we're going to have the future benefits. Means we pay the cash, but we didn't get anything yet. Prepaid rent will be one. Prepaid insurance, supplies. We pay for the supplies, but they haven't come yet. Because if you pay for the supplies, at some point the vendor can say, I'm so sorry, those items that you purchase, I cannot deliver them. They're not available, they're not on stock, I don't have them, I'm going to send you the money back. So what will be that? Let's do just one entry, and that will be the end of today. So let's go with the prepaid insurance. Prepaid insurance is the most common expense, which we're paying upfront and we receive it over the time. What will be the time? Every month or every quarter, depending when we're preparing the financial statements. So let's say this company purchase annual insurance. Annual insurance, that means for 1 year, means for 12 months, $3,600. Now the question is, did we pay for it? Yes, we pay. We pay cash right away. Insurance people, they want cash. They want it right away. But did we receive anything? No, we haven't. So what is it? The cash gonna go down, but something's gonna have to go up. What's gonna go up? Asset. Now we have asset. Prepaid insurance. Why is asset? Because at any point we can cancel that insurance. And you can say, I don't want the insurance anymore. Give me my money back. And you're gonna get your money back. With ICBC, if you prepaid your insurance, because insurance, if you pay at the time before the period before the insurance started, and you're using for 2 months, and then you say, I'm selling my car. I want to go for 1 year for traveling around the world. Give me my money back. They're gonna refund you for the remaining for the 10 months. They're gonna give you the money back. So let's say in our case that's not the case. So we prepay that insurance for 1 year. How much is per month? If 3,600 is for a year, how much is per month? Can you easily get it? 300 per month. So every month, what's going to happen? We have to move from prepaid expenses into the expenses $300. Why? Because month expired. That means we received the service for the insurance. Make sense? So that's why when the first month pass, end of May, what we're going to do? We're going to transfer $300 from the prepaid insurance into insurance expense. So we start using it. Does that make sense? So the question is, what's going to happen with the accounts? Well, in the beginning, we have asset account $3,600. That's May 1st. During the May, we received we received that insurance expense. First month, we received 100. We're going to show it as an expense. Now my expense is going to go with 300, but my prepaid insurance is going to go down with 300. Altogether, they're going to be $3,600. What's going to happen? How much will be, think about this, how much will be my prepaid insurance? How much will be the balance here on April 30 next year? What do you think? On April 30th, not on April 1st, April 30th. Insurance starts with May 1st. What's the ending date of the insurance? It's for 1 year. Zero. Make sense? I know. I just wanted to finish this because this is kind of important. That is true. But again, you can cancel it during the month. And for the day that you haven't received it, you can get a refund. That will be all for me for today. Next time we're going to see each other in class. So get yourself ready, do the questions, pay attention to pay attention for what I said today and incorporate it next time in your test. Thank you again for your today. Have a great day. Enjoy the rest of your day. Have a great week, and we're going to see each other next Friday, this time in person.